All right, welcome everyone. My name is Neil Bawa, and I'm one of the presenters for today's event. Thank you for joining us. With me, I have my partner in crime, my partner at Financial Attunement, John-Mark Lando. John-Mark, say hi.
Hi everyone, thanks for joining us.
Also, my co-host is Eric Golub from IRA Services.
Hi everybody.
All right. We're very excited to bring you this event. John-Mark and I have been slaving over this presentation, this educational presentation for weeks now. So we want to get started. Click here. I'm going to go get myself a laser pointer so I can point out some stuff. And here we go. So quick disclaimer. We are not investment advisors, and all investments involve some degree of risk. So be aware of your risk tolerance level. Also know that there are external market forces beyond our control that can affect investments. Lastly, don't just invest your money on our recommendation alone. It's very important to do your own research. All right, here's our goal for today, our plan. So we're going to start with the big why and the how. Why do people need to go beyond just the stock market and invest in other areas? And then how do they do that? How do they achieve high-yield investments? We're going to introduce you to the $2 trillion, you read that right, that's $2,000 billion U.S. multifamily market, and we're going to talk about these incredible market trends that are driving multifamily growth right now. We're going to explain to you how groups of investors such as yourself buy multifamily properties together. Most people can't buy multifamily properties by themselves, so they usually do a group buy. So we're going to talk about that. We're going to discuss the top reasons to invest in multifamily, in apartments. And then we're going to, if we have time, we're going to quickly go through the life cycle of a multifamily project, followed by a quick review. So let's get started. The big why and how. And this is really the crux of our presentation. The first part, I know this is written oddly because we really want you to think about this. Why can you not afford to invest in stocks and bonds? A lot of you people are invested in stocks and bonds. What we're trying to say is you need to go beyond that, and we're going to explain why. We're going to also explain why you absolutely must seek higher yield safely, and I believe 10 minutes from now you're going to agree with me. And then I'm going to talk about, and this is something actually I'm going to invite John-Mark to talk about, why are stock experts promoting real estate? So I'll do that in just a second, John-Mark. And the last part is, once we've talked about the whys, we're going to talk about how can you invest in real estate passively. No managing, no rehab, no flipping. So most of our presentation is about the how, but let's talk about the whys first. So I'm going to invite John-Mark to talk about why a number of stock experts are suddenly promoting real estate. John-Mark?
So yeah, this was actually kind of a surprise to me. I was at an asset protection conference a couple months ago, and I specifically wanted to listen to this stock expert, Joey Miller, because he had, he presents all these really cool stock option strategies. And he starts his presentation. I'm going, wait a minute, did I get my slides in there? He was basically showing a multifamily property in Texas. And a few minutes in, he said, well, the reason I'm showing you a multifamily property is it's not a question of when, it's not a question of if, it's a question of when. We've had a 7-year bull run on the stock markets. That is going to turn. And we saw a glimpse of that, a fairly large glimpse of that a couple weeks ago. Pretty good correction triggered by the Chinese economy. But in general, people in stock are getting edgy. Yes, they are still playing the game, but they are also looking to diversify and get into the real estate parts.
So let's talk about some of that. So the reason, and I'm going to go back to the whys for a second, why must you seek higher yield safely? Well, the answer is staring us in the face, and some of you already know this. America's Social Security and retirement system was designed for a different reality, different time, and there are 3 reasons for this. The first one is life expectancy. Your great-grandfather worked until the day he died at 49. Your grandfather probably had his retirement lasting him a few years. He lived to about 69 on average. That was the life expectancy in 1960. Well, now life expectancy is 79 years, and it's rising fast. I should say rising very fast. So your retirement has to last decades. and our Social Security system was not designed for that. The second reason is healthcare costs are rising far faster than inflation. How much faster? This much faster. They're rising at 818% since 1960. It's an enormous increase, and keep in mind that most healthcare costs come in the last 2 decades of life. I've heard numbers that say 70 to 80% of all healthcare costs are in the last 2 decades of life. So keep in mind, this is a huge reason why you must seek higher yields. And the third reason is the stock market itself. We hear a lot about stock market returns. What we don't hear about is what are the stock market returns adjusted for inflation. I'm going to underline that, adjusted for inflation, right? They're just too low to get ahead. Here are the returns, the actual annual growth over the last 14 years when you adjust it for inflation. This is my favorite calculator. If I start at June 2001, go to December 31st, 2014, which is 14 years, and I'm adjusting for inflation, including dividends, my true annualized return, my compound aggregate return, is just 2.99%. That means $1 invested in 2001 has only grown to $1.51. That's right. You've only gained 51 cents in 14 years on a dollar when you adjust for inflation. The stock market simply does not allow you to get ahead. So you need to look at alternative gains, alternative areas. So what are some of the things that you should do to get ahead? So this is John Mark's area, and he's been talking about it for a while, so I'll let him talk about it.
So I'm going to jump into, people talk about the time value of money, which is a fairly easy concept to grasp. Would you rather have $1 today or 30 years from now? And some people, obviously the quantification of that desire is what drives all of this. And if someone is looking to invest $1 today and at 2% interest, that dollar is going to grow over the next 30 years at 2% to about $182. Sorry, $100. Let's use standard for investing $100 at 2%. If you invest that dollar at 10%, you're going to get substantially higher returns. You're going to get 1,984. So it's a factor of 5 from 2 to 10, but you're multiplying way more than that to get up to 1984, almost 10x. If you jump up to 18% yields, then you pretty much go through the roof. I mean, you're $21,000 in some at 18% yield. So think about putting $100 in your savings account and leaving that same $100 charged on your Visa card. You're going to earn peanuts and pay huge amounts. So you really have to look at the power of compounding. If you turn this around and you actually have a little nest egg today that you want to invest and build up something that's going to yield, let's say, $15,000 a month in 20 years. And $15,000 a month might sound like a lot, but it's about 3 times or 4 times the average rent in San Francisco, where we're based. So it's not that much.
Plus inflation, right? Inflation is going to affect it as well.
Plus inflation, absolutely. So if you're investing at 2%, which is higher than most banks offer, you need to save $30,000 a month to build up roughly $9 million that's going to kick off the $15,000 a month that you're going to need. At 10%, that changes drastically. You're dropping to $23.70 a month. And at 18%, it's something almost all of us can do. You're saving $433 a month. This difference from $30,000 a month to $430 a month to have the same yield at the end is, I looked at these numbers in 1992 when I first started getting into real estate, sort of moving over from being a contractor and an engineer. Time value of money just completely skewed everything. I just had an aha moment, and I started getting into mortgages and financial instruments and really playing with this. But this is really the key to understanding why people who are in the stock market, even at average yields or even slightly better than average yields, or certainly in savings and bonds, are never going to get ahead of inflation. And that's kind of the big why for me to have gotten into real estate and have now been in real estate for 33 years and never looking back.
So now you know the why, right? So we've given you the why portion of the presentation. Now let's look at how. So with that in mind, first let's learn about what financial attunement does. So our name implies that we're passionate about having your assets work for you, fine-tuning your thinking a little bit about capital, about returns, about investing. We buy and manage multifamily complexes nationwide. Right now we own properties in California, Texas, Oklahoma, and we're currently syndicating a property in Illinois and Chicago. Our competency is really in asset selection, finding the right assets, and then managing them to improve their net operating income and their value. Between the two of us, we have roughly 4 decades of real estate experience. So I'm not dating myself. I think I'm just dating John Mark. So I think he has more gray in the picture than I do. So, all right. So let's get started. Here's an introduction to the wonderful area of multifamily. So first, what does the term mean? It generally means 5+ units, but it reaches true economies of scale at 150 units. The reason for that is 1 to 4 units are treated mostly as single family and get residential loans. So when you're buying a quadplex, you're really buying a big multifamily, and it's treated as a residential loan. But once you're at 5, it's treated completely differently. So let's talk about valuation. Multifamily properties are very different from single-family properties when it comes to valuation because the value is based on incomes. It's not based on comparables. This means you could have 2 identical multifamily properties sitting next to each other, identical in every possible way. One of them could be worth twice as much as the other because it's better managed and it has a higher net operating income, which means people will pay more money for it. So this is a paradigm shift. The most important slide in our presentation is right here. Here's an example. In a 200-unit complex, the management raises rents by $25 per unit. The value of that property goes up by an astonishing $750,000 instantly. This is how. 200 units multiplied by $25, multiplied by 12 months, divided by an 8% cap rate, and we're not going to go into cap rate in this presentation, but 8% is fairly standard. If you do this math, your property now is worth $750,000 more just because you increased rents by 25%, $25 a month. Every time. This works 100% of the time, and that's the magic of multifamily. Now, who manages a multifamily property? Well, they're run by professional property managers, on-site leasing agents, full-time on-site maintenance staff. You don't do tenants and toilets. We don't do tenants and toilets either. There's a team of people that are employed at the property, and they're there full-time. Typically, a 200-unit property might have 4, as many as 6 people involved that are full-time present at the property. How do we run it then, right? We use sales metrics, we use cost metrics, and we use profit metrics. So this is really like any other business, and we run it off of those metrics. We get the metrics from local data, and then we run it exactly like a business. So how do we get loans in multifamily? So we mentioned a while back that that value is based on loans. Value is based on income. Well, loans are also based on income and occupancy, not on your income or credit. In fact, you could have terrible credit and still qualify to buy a large multifamily property. Lenders do a very good job, and they do you, the investors, a tremendous favor. They scrutinize each property in great detail. They don't just want to look at the operating income today. They typically want to look at what is the operating income of this property for the last 2 years and sometimes even 3 years. They want to make sure that this income will continue to grow. So investors are protected when they invest in multifamily because lenders do a much better job of due diligence than they would on a single family property. So the focus really for people like us is on cash flow and on value addition. Our goal is take a malfunctioning property, a property that's not performing up to par, and raise it to par, raise the rents, and that raises the value, that raises the operating income, and the operating income raises the value. And so we're making our own market appreciation. We don't need markets to appreciate. So there's always a choice of balance between cash flow and market appreciation. If you have a property that has very high cash flow in the first year, it probably won't appreciate as much because a lot of the appreciation was really paid out to the seller before. So we look for properties where they're not being managed so well, so we have some upside, some ability to increase the cash flow in the first year. So how do we do this? How do we figure out where to go and find the right properties? Well, real estate has predictable market cycles, and what we do is we read these cycles and we time our investments accordingly, and we enter and exit markets. Let me give you an example. For example, right now, Chicago is somewhere in this area. We know this based on a number of factors that drive these cycles. We know that Dallas is somewhere in this area. We know that San Francisco is up here, probably up here. San Francisco is kind of insane. And so our goal is to enter a market not at this point, but somewhere here where it's already rising, and then rise it up here, and then sell it right about this point. We don't really want the last percentage of increase. We want to sell it at this point. And essentially rinse, repeat that process. Let's skip. All right. So how long is an investment for? 2 to 7 year investments are very common. This is not a fix and flip business. And investors really have to be prepared to invest for a longer time frame. So keep in mind, this is not fix and flip. We are doing some fixing, but not necessarily to flip, but to hold and then flip eventually after a 4 or 5 year time frame. And how are values less volatile than single family? Well, they tend not to decline sharply in a recession. People need a place to live during recessions. Rents tend to fluctuate less than home prices, whether it's going up or coming down. Now, also keep in mind, during recessions, there tends to be a migration of people who can't afford single-family homes towards multifamily. So multifamily does have some built-in recession-proof benefits. I'm not saying it's recession-proof, but it's recession-resistant because of its very nature. So I'm going to skip past this. I'm not sure if you have time. There are 3 building classes, and generally we focus on Class Cs, and the reason is right here. There's highest class cash flow in Class Cs and great upside. What we don't go for are Class Ds, which we qualify as don't buy, which tend to be in rough areas. So not our market. We tend to stick with Class C properties that are in emerging neighborhoods that have a chance of becoming B neighborhoods. All right, so let's talk about why there has been so much talk in the media over the last 4 or 5 years about very powerful and long-term multifamily trends. The number one is that there's a fundamental change that's taking place across America, and I think this will resonate with a lot of people. Rent is the new buy. Americans seem to suddenly prefer to rent, and there's so much data that supports this. So take a look at this. Here, this is a survey that was done by Appfolio and the Wall Street Journal. Only half of all renters said they anticipated becoming homeowners in the next 5 years. This number is lower than it's ever been. Here's another data point. 1 in 5 apartment dwellers and 1 in 4 individual property dwellers plan to stay where they're living for 5 years or more. So they're not looking to move up, not looking to move into a property that they've purchased. They're renting, and they're happy renting, whether it's a single family rental or an apartment rental. And this has also changed drastically since the Great Recession started. Now here's the part that's most interesting. Less than 1/3 of renters cited an inability to obtain a mortgage as the reason for not becoming homeowners. So they're saying, we can afford it, but we choose not to. And why is that? Well, that's this part here. It's about lifestyle. So a lot of people said they rent because they enjoy the lifestyle. So they can get friendly neighborhoods. They can get parks and playgrounds. They can be in a safe neighborhood. They can have a good school by renting. But when they buy, they get priced out of all of the good schools and all of the safe neighborhoods, and they don't want that. So as prices have risen, so we've had a change in America's opinion on renting versus buying, and it's really driving the multifamily market. So the last part, but very, very important, is millennials. These folks are clearly not interested in buying homes at the same rate as the previous generations. Now you take a look at this. Millennial home buying percentages were at their peak at over 17%. What's interesting is this peak is 2005, before the recession, and then it started dropping and dropping and dropping. This is 2015, 14, but in 15 it's continued to drop and is now below 13%. So true home ownership rate amongst 8 to 34-year-olds is at an all-time low and continuing to drop. This is huge, folks. This is enormous, because this means that if the trend does not slow down, does not stop, does not reverse, we're going to need to build millions of multifamily units. We simply don't have the supply to match the demand. And then there's the baby boomers. There's 75 million of these people. They're looking to downsize, and two reasons. One is urban apartments are convenient, but maybe they're looking to move closer to their kids, and their kids want to live in the city. So what we're seeing is that the 75 million echo boomers are looking to downsize, and that's again driving the trend towards multifamily. So very, very powerful trends are driving the multifamily valuations right now. It's an exciting time for those of us in multifamily. So let's show you how you can benefit from these trends. How do you buy into a multifamily project? Well, you buy together. Most multifamilies that have scale or economies of scale are above 150 units. Well, most people can't afford to put down the money to buy a 150 unit multifamily, so they usually do what is known as a group purchase. And this group purchase concept is known as syndication. So what happens is that the rules of syndication are governed by the SEC, the Security and Exchange Commission, for the protection of investors. So there's a set of very rigid rules that we must follow to syndicate properties. Here's how it's done. An experienced syndication team finds an asset and offers the opportunity to pre-screened investors, which is a process that we must go through with any of you that are interested, who then choose to participate or not. You can have individuals, you can have self-directed retirement plans, or entities, LLCs, invest many different amounts. So one group could invest $50,000, another group could invest $1 million, and they receive a proportional equity share of the cash flow and value gain. Now, the team itself that finds and contracts the property does all the due diligence, organizes it, pools the investor funds, and manages the property. That team also receives a share of the cash flow, which is typically 30%, and they also receive a small management fee. So what do they do with the property? Well, they assign an asset manager who is usually local to the property, lives there in that area, and has been in real estate for a while. And then they hire a competent property management company to run the company. The property management company usually hires between 3 and 6 employees that are full-time employees that work at the property. Once again, no involvement in day-to-day running, no tenants, no toilets. You typically get cash flows once a quarter, and you typically get preferred returns before the management team is paid. So both of those are typical, and both of those are true of our company. So you saw some of the trends in multifamily, right? But what if those trends were not there? People have been investing in multifamily for over 100 years. There must be reasons why people invest in multifamily regardless of trends. Well, there are, and these reasons never go away. So there's 10 of them, but I'm going to give you the top 6. Number 1 is cash flow. No one should buy a multifamily property unless it generates cash flow on day 1. And it needs to continuing cash flow until it's sold. This, I know, is not true of those of you who are Californians. There's lots of properties here that people are purchasing that do not cash flow. In our opinion, that's not necessarily a good thing. It's a very risky proposition. The second reason is forced appreciation. Remember that example that I gave you about how a $25 increase in rents increases the value of a 200-unit property by $750,000? That's what I'm talking about here. Forced appreciation. Every time you raise rents, every time a tenant leaves and a new one comes in and he's at a $25 level higher, or you have a unit that was beat up and you've now fixed it up and you put it back into commission, so now you have more units that you're renting out, well, you're raising the value of the property. So if you double the profit, you double the value of the property. And that's really the magic of multifamily there. Here's the next one. When people are buying single families, the management is not professional and there are rarely any metrics in use. With multifamily, it's a business. So if you buy a $10 million multifamily as a group, it's a $10 million business. So it's a truly passive investment because professionals are handling the operations. They've done it before, and they're very, very highly metric driven. Cost metrics, occupancy metrics, profit metrics. They do it every day, and they present weekly reports to the management team. It's a business. The next one is inflation protection. It's, I think multifamily is one of the best mechanisms out there to avoid the impact of inflation. In fact, single family is just as good. Real assets are key. You've got the Fed that is printing ridiculous amounts of money. They seem to have stopped for a while, but I believe that they're going to start again. And every other country in the world is doing it as well. And so the value of money keeps falling at all points of time. Money becomes worth less. Real assets tend to become worth more. So inflation is a huge reason why you should diversify out of something like stocks and bonds into real estate. Tax benefits. Multifamily properties take advantage of depreciation and equipment to offset a lot of the income. Early on, when you invest in the property, you're going to notice that your K1 that comes in for tax filing is actually a lot lower than the amount that showed up in the bank. And this is typical, and it's perfectly legal. It's an enormous benefit. The sixth one, and this is going to be huge for those of you who are in corporate America. So many economies of scale compared to single family, right? So vacancy will impact cash flow less. If you have a single family and a tenant leaves, you're at 0% occupancy. In a multifamily that's 200 units, if one person leaves, your occupancy has dropped by 0.5%. Marketing is easier. Everybody's coming into one area. Logistics are easy. You can have a centralized location for repair. Repair and maintenance and upgrades are easier because you've always got units that are empty. So when you're rehabbing them, you are not reducing your potential revenue. So many benefits. There's probably 20 others that are not on this slide that are economies of scale. So let's see. We've got 4:31, so we actually have time to go through the life cycle of a multifamily project, so I'll do that. So let's talk about all the different steps that a management team takes to go through the life cycles of a multifamily project. So there's 4 phases: pre-offer, post-offer, post-purchase, and then the sale phase. So pre-offer, well, that's where somebody like John Mark shines. He goes into a metro, he's looking at jobs. Where's the path of progress? How's that city moving? Where are the prices rising? Then he does the team creation piece. He starts calling on realtors and inspectors and property managers and contractors and builds a team of people that are funneling high-quality deals to him that are off-market. He starts doing his opportunity search within target areas that he's defined. And then he starts to walk all of the comparably sized properties for sale so he can understand where those properties are, their strengths and weaknesses, which areas are better than the others, and which properties are better than the others. Now, once he has a property, he makes a first offer, and that's based on the seller's financials. So the seller will give us the financials saying, well, here's my net operating income, here's my rent statistics for the last 2 years, and he makes a first offer, ending the pre-offer phase. Then he moves into the post-offer phase, and there's 3 massive steps, and this is thousands of hours of work of due diligence. I'm going to bring them all up. So first he starts with roofs, looks at sewers, runs cameras in sewers, looks at the repairs, all the unit conditions. Are carpets any good? Are hallways lit? What about the exteriors? Are the bricks falling apart in areas that have snow? We often have issues with bricks splitting. What about the electrical, the plumbing, the mechanical systems like the HVAC and the air conditioners? Then, once you've done this part, then you verify the financials. Are the rents really coming in? Are the occupancy levels as per the seller's numbers? What about delinquency? Are people paying late? Is the staff competent? Is this a property management staff that we want to keep, or maybe we want to turn them over and get your own staff? Then the last part, which is just as important, is then someone like John Mark will walk the comparable properties that are on sale. So what he's doing is now that he's looked at the property, he's now looking at all of the other properties to make sure that the one that he's buying is better than the others. So 3 phases of due diligence. And then when he's done with all of that, you start negotiating the repair credit. So price reduction is negotiated after financial verification. So you might actually have a price reduction happen because the financial numbers that were provided to you were incorrect. And if the seller does not agree, well, the deal dies. And you start again at step 1. Hopefully the deal doesn't die, and the team starts promoting the opportunity to their investors through webinars and investor summary and financial projection documents. And lawyers start creating legal entities. This is very important. A number of you folks are worried about the legal exposure that real estate creates. It's there. But the beauty of it is, in multifamily deals, you've got specialized lawyers that are being paid tens of thousands of dollars to create legal entities that protect investors and protect the management team. So purchase is typically completed within 75 days, and then, well, actually, those two slides should have been flipped. The management team works on loans with lenders, and then investors wire in the money so that purchase can be completed. So now this is, once again, thousands of hours of work to get to this point. Now, the management team starts making changes to the property management team. For example, we have a property coming up in Chicago. We're keeping none of them. There are 5 or 6 people involved. We've decided to keep none. So even though we're in escrow right now, we're already interviewing their replacements. So we make upgrades, amenities, interiors, exteriors. So the goal is, let's enhance the tenant satisfaction, because a lot of delinquency really comes from unhappy people. Let's make them happier, and let's make the curb appeal much better than it already is. So we'll often repave the parking lots, because that's the first thing that people see when they come into the property. And we'll upgrade the common areas. So management will then transition out or evict undesirable tenants. A lot of multifamilies, especially in C areas, will have a few undesirable tenants, and it's a bad apple situation. So the management will evict those, bring in better tenants, and those tenants are coming with higher rents. And then repair budget, the budget that you negotiated, which typically is hundreds of thousands of dollars, is used to improve the asset. So over the first 3 months, you're improving the asset. Now you're in a position to improve rents. You can lower the expenses and start improving the profitability. The investors, each quarter, they get checks for available cash flow, and they receive financials, and they also get a very detailed property reports from the management team. So the last part, the happy part of this whole process, is we run the complex now that we've stabilized it, we've raised the income, we run it for 3 to 5 years. And then with market appreciation, rent appreciation, better management, the NOI keeps growing until at one point the net operating income reaches our exit projections, which are provided to investors when they're investing. When we reach the exit projection, we put the property up for sale, and we aim to complete the sale within a 6-month time frame. At that point, you get your principal back along with the profits from the sale. So long process, but now you've gone through the entire life cycle of a property, which typically takes 5 years. So I know we covered a lot of content. I'm going to do a quick 1-minute review and also give you an action path. So you learned about this massive $2 trillion professional multifamily market. I think you now know we've got a once-in-a-lifetime broad market trend opportunity that's driving the multifamily growth. We discussed only 6 of the reasons why people invest in apartments. I wish I had more time. You also learned how investors buy properties together, and you went through the life cycle of a project. So now I want you to take 90 seconds with me. If you're interested in multifamily and would like to know more about how to invest in a property, take action. So here are the next steps. If you want to learn about a current multifamily opportunity, including a high-def video tour that shows you the properties and shows you the amenities and all the local improvements that are happening in an emerging market, you should go to this URL, www.financial-attunement.com. Please note the spelling of attunement.com/next. Please note that there is another slash here. I'm not sure if it works without the slash at the end. So it's /next/. So you can do that, or you can email us for an opportunity list, and we'll send you a list of our open properties. So that's our email address. Or you can call us at this phone number for a discussion on how apartments can be part of your portfolio. So I'll turn it over to John Mark for a recap, and then we would like Eric to tell us about self-directed hiring.
So I think that you've pretty much done the recap, but I mean, just my love of multifamily started in 1982. Working as an engineer, I couldn't qualify for a single-family house at 19% interest rate that prevailed at the time. So I ended up buying a sixplex, and that's counterintuitive, but the lenders were looking at the rents coming in rather than my income, and that changed the equation. And when I bought the property, quit my job, rehabbed it, And a year later, when I went to refinance, rates had dropped to the incredibly low rate of 12.5%. And pulled out 4 years worth of salary, and there went the engineering career. But I've been playing in multifamily space ever since. I have, of course, done some single-family projects. I have always done better on multis, and at this point, don't ask anyone. I'm not even looking at single families anymore. I always look longingly, and I think, oh, that would be cool to rehab and do this. But I've picked some multis, have done really well with that, and Neil and I are having a ball just putting these projects together. So back to you.
Fantastic, fantastic. Yes, great recap, John Mark. All right. Okay, great. So I don't need control back, Eric. Just answering the question. Number one is, do you get 30% of the cash flow or profits plus a management fee? The answer is yes. The management entity receives a percentage of the cash flow, 30%, a percentage of the profits, and they also get a small management fee because there's a local asset manager and he or she has to be compensated. What percentage of property purchase costs are you paying per property, or are you only using other investors' money? Well, it's a mix. So speaking just for myself, my company, John Mark and I both invest into our properties, and then a number of investors that we've worked with in the past invest with us as well. So loans usually make up 80% of the purchase price, and the money that investors put in and we put in make up the remaining 20%. The next question was, is your model based on an investment pool across multiple properties, or is each investment based on a specific property? In our case, based on a specific property. And that's what we recommend, because if you're making an investment based on a pool, how are you in a position to judge whether it's a good investment or not? In our case, we do about 4 or 5 properties a year, so you can look at each individual property and decide if you want to invest in one or the other. So you can choose, maybe out of 5 properties you invest in 1 or 2 a year because you didn't like the other 3 or they didn't match your risk profile. So in our case, the model is based on investment for each individual property. The next question, which seems to have been repeated a number of times, is, go ahead, John.
Just to jump in there, every so often, like right now, we're buying a group of 6, not quite adjacent, but closely geographically related properties. And that is considered, we're considering that one property, one investment. So we're not buying pools across multiple states. This is all within 3 blocks. Just to clarify that.
Right, but that is, so in that instance, that's considered a single purchase, not a purchase of 6 separate buildings, because they're part of one portfolio. So the other question that's very popular is, can we get a copy of these slides? The answer is yes. You will receive a copy of the slides and a copy of the webinar itself in your email, along with our next steps link. The next question was, what are the returns like? Well, the returns vary. And I think the best thing that we can do at this point in time is point you to the link that we've provided, which is financial-attunement.com/next. In there, you can actually see one of our properties, and you can see what kind of returns it has. All I can mention is that they're double digits. My next question is, the projected double-digit cash flow and value gain, is it the net for the investor after the 30% fee to the management team? The answer is absolutely. We would not consider it to be double-digit gains if we took a portion of it, which reduced it to single digits. So all gains that are projected in our documents that are at that link are net of costs and net of our 30%. We actually show you those in separate lines, so you can see what portion of it we receive and what portion of it you receive. So yes, net of 30%.
Thanks very much, Neil, and thanks, Jean-Marc. Can you see my screen okay there, Neil?
Yep.
I can certainly see it here. But I'm going to give you a little rundown on self-directed IRAs. Now, it's some subject that really thrills me because it's disruptive within the area of retirement accounts. This has always been a possibility. This has always been permitted by the IRS, namely to invest in alternative assets such as real estate or gold, as you can see in the imagery here. You could build your nest egg on a combination of alternative assets such as real estate or precious metals. You're not limited to publicly traded securities. And I found it very compelling, the example you gave there, Neil, how when properly evaluated, the returns of the stock market over the last 10, 20 years, for example, are not nearly so great when you factor in the inflation adjustment there. And that's where real estate can, you can really address that because you've got income producing investments. Anyway, here we go. I'm just going to give you a little bit of the disclaimers about retirement accounts, just to let you know this is for general information purposes. We're not providing tax, legal, or investment advice as such, and you shouldn't rely on my words any more than Neil's or Jean-Marc's as investment advice or legal advice as such, but certainly ideas we're putting out there. Self-directed retirement accounts and the selection of the alternative assets in them are the sole responsibility of the investor. Whoops, excuse me, and that's kind of the beauty of it in a way too, that they truly are self-directed. You know, IRAs always have been self-directed, but this was somewhat obscured by the illusion that you were not directing it because you were investing in mutual funds or other offerings which were provided for you. You had relinquished a little bit of the choice in the first place and therefore some of the responsibility. And so that's why we really stress these points here. IRA Services Trust Company will help facilitate whatever investments are permissible and administratively feasible. But on the other hand, we will not do any of the due diligence on the particular investment that you submitted. And it's important to remember when you submit investment paperwork to us, we're checking them over to make sure they're filled out correctly and they're clearly in terms of what you're authorizing us to do, not whether or not the investment itself is something that we consider to be advisable or a recommended sort of thing. And so that's why we're talking about IRA Services strongly recommends that investors seek professional advice from the appropriate legal, accounting, and or tax advisors. And again, this is just we're just utilizing this to describe how you can use a self-directed account, and there are many, many ways. And we're just talking about one particular kind of asset class today, and a promising one at that. Now, a self-directed IRA, as I already referred to a little bit, doesn't really mean the kind of IRA you have, because your self-directed IRA may be a traditional IRA or a Roth IRA or a SEP IRA. So this isn't really changed. The IRA type is still traditional IRA or Roth IRA or SEP IRA. But self-directed simply means you have it administered at a custodian such as IRA Services Trust Company, which specializes in allowing to self-direct. In other words, we're familiar with how to administer the whole range of assets permissible under the Internal Revenue Code. And so like it says here, that's your choice. It's limited only by, sorry about that, it's limited only by what the Internal Revenue Code says. And really almost all assets are permissible. The general prohibitions are life insurance, a life insurance related product, or collectibles. Collectibles are sometimes confusing in the area of precious metals, but precious metals are clearly defined under the Internal Revenue Code. Bullion and bullion-related products, precious metals where the actual coin or bar or round is based entirely on the precious metal content, but not on any kind of numismatic or collectible value of the coin. In other words, you can hold gold coins of a certain type and fineness of gold or silver, for example, but the value, you're not holding coins in there that are valuable because they're a 1904 and therefore expensive because of their rarity. That makes sense. So moving on, how do you choose a self-directed IRA custodian, or how do you choose any kind of IRA custodian? You're going to want to look at their fee schedule first of all. What do they charge to make a transaction? For example, what's the fee to buy a piece of real estate or to buy shares in an LLC, which is formed for the purpose of buying and selling real estate? What are the ongoing maintenance fees? We call them account fees, but some firms call them maintenance fees. Typically, you'll pay a quarterly fee simply for the account administration, and then a quarterly fee. And the way we do it is you pay a small quarterly fee for each asset you own. And so, for example, if you held an LLC put together for the purpose, or a private placement that owns buys and sells real estate, $12 per quarter is what your ongoing fee just to hold that one asset would be, and then a $24 quarterly account fee. So really $36 per quarter, irrespective of whatever transactions you might have been making, is all you'd be looking at to maintain the account here. Termination fees, a lot of firms will vary quite a bit in terms of whether they charge you a fee to leave that particular custodian. If you transferred the account out, will they charge you any fee at all, or will they charge you sometimes significant? Some firms will charge you a percentage of the overall balance that's being transferred out. That can be quite hefty. Storage fees, in the case of precious metals, those tend to be fairly standardized, but you really want to look over all those and get a totality of that. And of course, you want to make sure that they will be able to hold the assets in which you plan to invest. In other words, can they actually consider that that investment is administratively feasible, as we put it? For example, when firms bring in a kind of investment idea that has a subscription agreement, some kind of a private placement or LLC or trust entity that's been created for the purpose of allowing multiple individuals to invest in whatever assets, real estate, or combination of things in the portfolio. We have to have that subscription document looked at by our compliance department. But I always have to caution clients that this doesn't mean our compliance department is approving the asset, saying, yeah, this is a feasible or a logical asset or an advisable kind of investment to make. No, we're simply making sure that it's something that's worded and structured in such a way that the IRS, when they look at it, will say, yeah, we followed the guidelines of what is in the Internal Revenue Code as to what's permissible or not permissible in a retirement account per their guidelines. And some of the other features too. Do they offer online access to your account? Will you get a message, a confirmation when transactions are initiated? Even another little bonus, in the Bay Area, for example, does their location allow customer service availability? Now, most transactions and most information, we're available to clients on the phone and by email all the time we're here at the office. But once in a while, especially for real estate-related transactions, certain clients do really want that last little bit of touch, close touch feel quality to the last-minute process of getting the paperwork just right, and this is another opportunity too. They can certainly arrange to have an appointment and bring the paperwork in, and one of our reps will actually can sit down with you. But you know, usually these documents can be faxed or even scanned and emailed. So now, can all IRAs be self-directed? Traditional, Roth IRA, SEP IRA, simple IRA? Yes, they certainly can. And this is just a little bit of a breakdown, what you may already be familiar with, the contribution limits for the different types of IRAs. There's no difference really between the IRA that you hold at a brokerage company or a bank custodian in terms of what amounts you're allowed to contribute per year, or how many rollovers are you permitted to make during a year. The only thing that is crucial here is that since you're at a self-directed IRA custodian, and of course we've been doing this for almost 40 years, we've got over 40,000 clients and over $4 billion under administration, so we're very experienced with the entire range here. The only limitations you're looking at are they administratively feasible? Can we tell right off the bat whether or not it's permissible per the IRS? What is an alternative asset? Well, one simple way is it's not publicly traded on an exchange. So in other words, you might buy a stock, but it's not a public stock, a pre-IPO stock, for example. You can't really buy that at your Schwab IRA or at another bank-based IRA custodian. Because it's not publicly traded, and therefore everyone everywhere can't actually determine what the current price is and what the movement is on that price. But a non-public stock is a very common and popular asset that's available to folks in a self-directed IRA. Here's another definition: does not fit into, sorry, every time I touch that screen, does not fit into traditional asset class definition of domestic equity, international equity, fixed income, or commodity. Well, again, typically it's not a publicly traded security, although you certainly can also hold publicly traded securities in your self-directed IRA. And again, just a little survey: real estate promissory notes, which might be secured promissory notes, which be what we ordinarily call deeds of trust. In other words, a promissory note that's secured by real estate. And we have the whole gamut here: private stocks, non-public stocks, for example, LLCs or LP investments, and often those are going to be an entity which is created specifically for the purpose of one or more IRAs, or maybe even an IRA and a couple other entities who are not IRAs going in together, sharing an investment in this LP or LLC, which is invested in a portfolio of real estate holdings, or maybe a variety of assets. And you have this other kind of variety as well here: various kinds of commodities, foreign currencies, structured settlements, life settlements, precious metals, of course, continues to be a very popular vehicle for self-directed IRAs. The bottom line for us is investing in what you know, and it occurred to us that folks often have certain orientations in their life, or they have life experiences or interests which have made them gain competence in certain kinds of investments, certain kinds other than mutual funds or public stocks. If you have a kind of personal interest or involvement in real estate already, it stands to reason you may be able to put some of this knowledge to work in investing in what you know. And so that's part of what our motivation is for making these services available. Are there restrictions? Well, yeah, and I've talked about the Internal Revenue Code, and we have to be quite well versed in what's permitted and what's not permitted, and it can be difficult to be sure. And we even, I continue to study each year on what private letter rulings have been indicated on a contested case regarding a complex investment that might have been assessed a fine or a penalty by the IRS, and sometimes it's overturned by the tax court. But prohibited transactions typically regard the sale or exchange or leasing of any property between a plan, such as an IRA, and someone who's disqualified vis-a-vis that plan. And so that would be perhaps the individual whose IRA it is. That's really a fundamental one. For example, Neil sets up a self-directed IRA. He can buy real estate in that IRA, but his IRA is not permitted to buy real estate from Neil Bawa in particular, or from Neil's wife, or from his children. Someone who's disqualified vis-a-vis that IRA would include, most obviously, the person whose IRA it is, and the immediate ascendant and descendant family relations of the IRA holder. And so most of the other real obvious prohibited transactions or disqualified parties really follow from that same principle here, as we can see right here. Also, maybe the most chief secondary one is act by a disqualified person who is a fiduciary or who already has some interest. In other words, you can't use your IRA to invest in a company which you already have a controlling interest in or receive some compensation from personally. The basic principle here is the IRS doesn't permit you to receive real-time, present personal gain from an asset that you've invested in your IRA. The idea is you're only supposed to get gain down in the future. You're tax deferring your investments in your IRA, and you get the gain down in the future when you take your monies out of that IRA at retirement or beyond retirement age. So again, a little bit more just kind of summing up the basic don'ts. You can't borrow money from your IRA. Your IRA, on the other hand, can loan money But again, you're prohibited from loaning money to yourself or someone who's immediately related to you personally, because then that could be perceived as really still indirectly benefiting yourself out of the transaction. So what's the self-directed investment process? And this converges nicely with Neil's kind of step-by-step process here. But really, once you have, this kind of presupposes you've decided your investment goals and objectives. You've educated yourself, consulted trusted advisors, determine how much you will invest or can invest, select a custodian. You've found the one who is the most congenial and the most fee-friendly, like an IRA Services Trust Company. You identify the investment and conduct your own due diligence on it. Now you're ready to direct your custodian to make the investment, to submit the investment documents to Eric or someone at IRA Services for processing. And again, this is a little bit of reiteration about, do I need a custodian? Well, yeah, for a retirement account to allow this tax deferral for retirement, you have to follow the game plan that the Internal Revenue Service provided some time ago. This has been in place for over 30 years, really. All of these things I've been kind of breaking down about what can and can't be done. So again, we don't give tax, legal, or investment advice. We don't promote any investment product. We don't endorse any performance statements made by Neil or other investment sponsors or issues. And your custodian, your IRA Services, your custodian, really is directed by you. What we do is simply report to the government what has been done. We report to you, and we custody the assets that you have directed us to purchase for your account, and we execute the transactions that you have instructed us. That's really pretty constrained, you know, what our functions are. Reporting and executing as requested by the clients. Now, what does it really take as far as the process? You can have the account set up in about a day or so. Essentially what you do, we have an online setup. You can go right on our website, iraservices.com. We allow you to establish the account online. If you have your current IRA statement handy, you can refer to that, and actually you can initiate the IRA transfer at the same time you're establishing your account online. Essentially, that's done pretty much instantaneously. In about 10-15 minutes, you can complete that process. At the end of the process, you are instructed to print out several pages. A few are for your own records, but a few are for you to get an ink signature on and toss in the mail to us. And so essentially what happens is, from the time we receive the photocopy of your driver's license, the setup fee, which is our $35 online, plus the first quarter's account fee of $24, so put that together, it's $59, your photo ID, and then the signed application acknowledgement form, essentially the page you printed out at the end of the online application. Toss that in the mail to us, and from the time we receive that, we'll open the account immediately. Now, if you have a transfer authorization that you filled out at the same time, and when you sent in your signed pages, you included the statement for that transfer, then we'll send out the transfer request then. Within a couple or 3 weeks, typically, the funds will be starting to come back from that other IRA custodian in response to our transfer authorization on your behalf, and you'll now have an IRA established with funds in it. And during this time, the first couple of weeks or so, you can have been already providing us the investment documents for us to review. You can have been getting the professional guidance as needed. And so finally, the custodian will complete the investment. We'll be able to execute the documentation, and there you have it. You'll have your asset in the account, your piece of real estate, or your shares in an LLC to invest in real estate, or your order will have been executed to buy gold or whatnot. So the turnaround time, really, as you can see, the one that takes the time out of the whole picture, the real major elapsed time is how long it takes for the funds to arrive here from the previous IRA custodian. And this is variable because custodians, IRA custodians, vary greatly in terms of what form they will accept the transfer authorization letter in from the new custodian, the one who's going to be asking for the money to be sent to them. So for example, if you're establishing your IRA with us and you're requesting a transfer from that other custodian, that custodian may require us to mail it to them when the original, which means you're going to have to actually get us the original ink signature transfer form because that other custodian requires it. In the case of certain other custodians which allow the transfer authorizations to come to them by fax, then that won't be the case. So there's a part of due diligence that's really crucial, and that's looking into what the requirements of your current IRA custodian are as far as dispersing the funds and what form they are going to require the transfer request to come from IRA services, because that'll make a big difference. And Eric, that's yours truly, or one of the people here in our contact center or other departments can always help with some of these questions too if you're in the process of setting up the account and kind of puzzled by this. Now to get to the fun part, the investments themselves. Now a very common investment that I've referred to is setting up an IRA LLC, either an IRA LLC or simply an LLC, irrespective of the IRA, because as we're going to see, you set up a new self-directed IRA and now you can fund this entity, which may be a brand new entity that you're newly investing in. It might be a newly established limited liability company, or it might not be. It might be an IRA LLC which you, the IRA holder, had an attorney draw up specifically just for the purpose of creating a vehicle for your self-directed IRA in which you can buy and sell various assets. And what that does, that LLC, that IRA LLC, would give you a kind of checkbook control. The IRA LLC is a discrete company, albeit owned entirely by your IRA. And that IRA LLC is entitled to create its, since it is a company, it creates its own bank account. It gets a bank account. And so once you establish your IRA with us, you've provided us the sufficient paperwork to fund an investment in this new IRA LLC. We've transmitted the funds to the IRA LLC, and it's deposited into the bank account that you've opened for that company, that new company, the IRA LLC. Now, the IRA LLC is able to do its buying and selling without having to go back through us as custodians for the IRA. In other words, the money is still to be seen as taking place within your retirement account, but since you have already funded an asset from your IRA, namely the IRA LLC itself, now for your IRA LLC to buy the real estate, the multifamily unit or whatever you're thinking of buying, you don't have to then go through us to transact it because you've got funds at the IRA LLC bank account. And the asset can now be acquired by the IRA LLC. Now this is kind of relating to how your funds are coming to the IRA from the previous account. Now you had an IRA elsewhere which you can transfer, or you had a 401k somewhere which you can roll over, and now you've funded this asset in the account. The asset in the account is a company in its own right, and it can be making investments of its own. Suppose your IRA LLC now sells that asset and wants to take the profits. If you, the IRA holder, want to take the profits back to the IRA. Maybe the cash, okay, the cash is back in the bank account of the IRA LLC. That's fine. You have it available if the IRA LLC wishes to buy another property. But you may have a different investment idea and you want that cash back in the IRA itself. Well then, and only then, you must disperse the IRA back to us so that it can be held as cash within your IRA proper as cash. That would leave you now with an IRA where you own an IRA LLC of uncertain valuation, since you've just sold an asset within it and sent the cash back to us. and you've got some cash which has been returned to us from the IRA LLC that you own in the IRA. And then a further step, what if you wanted to actually take a distribution of cash from your IRA? That would require yet another step. You'd have to give us the instruction to distribute X amount of cash. And of course, you'd have to have actually dispersed the cash from the IRA LLC back to your IRA before it's actually available for your IRA to distribute. It would not be permissible for you to take the cash that's in the bank account of that IRA LLC and simply take it and use it personally, bypassing the IRA custodian itself. The IRS will find out about that, and there will be serious consequences. They'll consider that to have somehow nullified the actual tax deferral properties of the IRA itself. So it's a serious thing to avoid doing. And of course, we can always provide more detailed advice on any of these related questions, because it can be a little complicated.